If you're thinking about buying a home and you're curious how the pre-approval and mortgage process actually works, this video is for you. We're going to walk through the entire process from pre-approval all the way to closing so you'll know exactly what to expect. There are many different loan types and we cover those in other videos. In this video, we're focusing strictly on the process, what happens, why it happens, and how to make it as smooth as possible. The very first step in buying a home is getting pre-approved. To clarify, there's a difference between a pre-approval and a pre-qualification. A pre-approval is when we review your application, documentation, and credit. A pre-qualification is simply where we take stated information and let you know approximately what you qualify for. It's not as concrete and comes with significantly less certainty. A pre-approval tells you two critical things. One, what can you qualify for? Two, what you personally should be comfortable affording. These are two very important distinctions. It's not just about the maximum price a lender will approve you for. In fact, that's usually the wrong place to start. I prefer to begin with your comfort range for monthly payment and down payment, and then work backwards to a realistic price range that fits your comfort level. To do this, we start with a loan application to gather the key details. From there, we review documentation for income, assets, identification, and of course, credit. Once everything is reviewed, we set up time to go through it together. We'll talk through your debt to income ratio, loan programs, down payment options, interest rates, closing costs, and next steps. For income, we'll review pay stubs, W-2s, and sometimes tax returns. Tax returns aren't always required. They typically come into play if you're self-employed or a business owner, if you're receiving rental income, if you're qualifying with capital gains or dividends, or if you're taking regular distributions. One important clarification: if you own a business but pay yourself as a W-2 employee, you are still considered self-employed. Tax returns are still required. W-2 employees are qualified based on gross income. Self-employed borrowers are generally qualified on net income using specific calculations that factor in business expenses and trends over time. Think of it this way: you're qualified on your taxable income. Next are assets. We need to verify that you have enough funds for your down payment, closing costs, and in some cases, reserves. Any large deposit, typically anything greater than 50% of your qualifying monthly income, must be sourced. This is critical. Quick warning: if you have physical cash sitting at home, do not deposit it. Cash cannot be sourced and may become unusable for the transaction. If a family member, spouse, or relative is helping with funds, we'd like to know that up front so we can structure that correctly and guide you through what is required. For credit, we'll review your FICO scores from all three bureaus and your existing debts, student loans, auto loans or leases, credit cards, other mortgages, and so on. Your debt to income ratio is one of the main factors that determines affordability. We look at everything on a monthly basis: gross monthly income, existing monthly debts, and estimated housing payments for the new property. This, combined with your down payment, drives your options and qualifying range. Once everything is reviewed and we've mapped out our budget, we issue the pre-approval letter. This can happen very quickly. In straightforward situations, I've pre-approved buyers in under 10 minutes. That said, I strongly recommend starting early. Many buyers wait until they find a home and need to submit an offer immediately. Sometimes that works, other times it doesn't, especially if there are credit issues, income nuances, or documentation gaps you didn't know existed. Starting early avoids unnecessary stress and surprises. Once your offer on a home is accepted by a seller, we shift into the underwriting phase. This is typically when we'll discuss locking in your interest rate. We may also request updated documents at this point. You'll receive your financing disclosures, which include your application, required federal and state disclosures, as well as your loan estimate. The loan estimate breaks down your loan terms and costs. It's common for some figures to be slightly overestimated. Don't panic, but do ask questions. We're happy to walk you through it. After disclosures are signed, the file is submitted to underwriting for initial review. Around the same time, we may also order the appraisal. Initial underwriting typically takes 24 to 48 hours, though timelines can vary. Once reviewed, underwriting issues a conditional approval, which is a checklist of what's needed to reach final approval. This usually includes things like appraisal, title work, insurance, and any remaining documentation needed. If the pre-approval was done correctly, there's usually very little left for you to do when we reach this stage. Once all conditions are satisfied, underwriting issues the clear to close. This is the green light. We want this as early as possible, so the only thing left is your scheduled closing date. Sometimes you can even close early. Shortly before closing, you'll receive your closing disclosure, which shows you the final numbers. It looks very similar to the loan estimate, but the closing finalized version. For closing funds, you'll either wire the money or bring a cashier's check. Personal checks are not allowed. We recommend completing this a couple days ahead of time to avoid last-minute delays. At closing, you sign the documents and get your keys. That's it. You're officially a homeowner. Within a couple weeks, you'll receive information on how to set up your mortgage payments, usually by email and regular mail. If you don't see anything after a few weeks, reach out so we can help. You'll also start receiving official-looking mail offering copies of your deed or promising unbelievably low refinance rates. Most of these are scams. If you're unsure, ask. It's also very common for your mortgage to be sold to a new servicer. This can happen multiple times over the life of the loan. Your loan terms cannot change, only where you send the payment changes. Do not ignore these letters, and if you are unsure, please check with your lender or call us. Even after closing, we're here to help, whether you have questions, want to buy another property, or are considering a refinance. That's the pre-approval and mortgage process from start to finish. If you found this video helpful, please make sure to subscribe or follow us on other social media platforms. Thanks so much for watching.